They told you $50. They lied. The real price stands above 80, and the math behind silver tells a radically different story. Bloomberg analysts predicted a collapse back to 50, claiming mean reversion would crush the rally and end the bull market immediately. CNBC amplified the narrative, mainstream commentators called the top, and investors were urged to sell before everything supposedly unraveled. They were wrong, demonstrably wrong, mathematically wrong, and historically wrong based on every inflation-adjusted and ratio-based metric available. The fear campaign tried shaking you out near the lows because deeper calculations point toward $200 as fair value. This is not speculation or hope, but arithmetic certainty derived from inflation data, gold-silver ratios, and institutional accumulation patterns. Tether did not accumulate 148 tons of gold, expecting a minor 10% trade. China did not reclassify silver as strategic, simply to watch it drift sideways around $80. They are positioning for a repricing event driven by scarcity, monetary debasement, and structural supply deficits. Inflation charts reveal that $50 in 1980 equals roughly $200 today in purchasing power. The gold-silver ratio shows that historical averages imply triple-digit silver at current gold prices. $80 is not expensive. It represents a new structural floor supported by strong physical demand. $200 becomes the logical target when multiple independent models converge on identical conclusions. Before exploring the mathematics, understand this community values data, engagement, and independent verification over media narratives. Commentary matters because collective insight sharpens decisions in volatile commodity environments like precious metals. In late January 2026, silver reached an all-time high above $121 per ounce. A violent correction followed, dropping more than 30% and dragging prices toward the $80 region. Mainstream headlines immediately declared a crash, forecasting a collapse toward $50 or lower. Yet silver stabilized, rebounded, and invalidated the catastrophic predictions within days of peak pessimism. As of this morning, silver trades above $81, posting strong year-over-year gains. Even mainstream outlets quietly admit a full reversal toward sub-50 levels appears unlikely. Why issue the $50 call initially? Because panic creates opportunity for institutional accumulation. COMEX data shows massive physical withdrawals during January, draining registered inventory at alarming speed. Over 33 million ounces exited vaults within 7 days, roughly a quarter of supply. Total deliveries in 2025 more than doubled the prior year, signaling escalating physical demand. In February, delivery rates approached 98%, indicating contract holders wanted actual metal. That is not speculative futures trading. It represents allocation of tangible bullion. The strategy becomes obvious. Crash paper prices, trigger margin calls, force liquidation, then accumulate physical quietly. If institutions expected lower prices, they would not empty vaults at record withdrawal rates. You do not drain inventory when anticipating decline. You accumulate before appreciation accelerates. The $50 narrative functioned as a wealth transfer mechanism from retail to institutions. Now consider inflation mathematics behind the 1980 peak of roughly $50. Using official CPI, that peak equals approximately $150 to $170 today. Even conservative government calculations show current prices remain historically discounted. Alternative methodologies place the inflation-adjusted peak closer to $200 or higher. Silver at $80 today resembles roughly $25 to $30 in 1980 purchasing power. Silver at $200 today merely equals breaking even with the prior inflation-adjusted high. A $50 target today implies real prices below mid-1970s levels. That argument ignores decades of currency expansion and trillions created through stimulus programs. It disregards explosive industrial demand growth and declining above-ground inventories. Therefore, $80 is not expensive. It remains historically cheap by monetary standards. Pause and consider currency debasement since 1980 when evaluating fair silver valuation. Trillions printed, balance sheets expanded, yet silver supposedly belongs below its real peak. Now examine the gold-silver ratio, a centuries-old monetary relationship. Gold trades above $5,000 while the ratio hovers near 62 to 1. Historically, the ratio averaged between 12 and 25 to 1 over long spans. A compression toward 25 to 1 with gold unchanged implies silver near 200. The arithmetic is simple division, not speculation or emotional forecasting. 5,000 divided by 25 equals 200 exactly. Even a moderate move toward 30 to 1 produces substantial triple-digit silver. The ratio already compressed dramatically from extremes above 100 to 1. History suggests the reversion process remains incomplete rather than finished. Now connect institutional behavior to this mathematical framework. Tether steadily accumulates gold weekly, allocating meaningful portfolio percentages to hard assets. Strategic investments expand infrastructure for tokenized bullion access globally. China restricts silver exports, classifying the metal as strategically essential. Exchange inventories decline rapidly, while open interest remains elevated. March contracts represent multiples of available registered supply. If significant holders demand delivery, supply stress intensifies quickly. Persistent structural deficits extend into a sixth consecutive year. Industrial demand from solar, electric vehicles, and electronics accelerates. Most silver production remains a byproduct of other mining operations. New primary mines require many years before meaningful output arrives. Strategic materials trade with scarcity premiums once supply risks emerge. Silver's evolving classification from industrial to strategic monetary hybrid changes valuation dynamics. Repricing events occur quickly when markets recognize structural imbalances. Volatility accompanies asymmetric upside in commodity bull cycles. January's collapse tested conviction but established resilience near 63. From 81, upside scenarios toward 100, 50, or 200 offer substantial percentage gains. Downside risk appears comparatively limited relative to demonstrated rebounds. Probability-weighted returns favor accumulation rather than panic selling. Independent pillars support the thesis: inflation adjustment, ratio mathematics, institutional accumulation. COMEX withdrawals confirm physical tightening beyond paper narratives. Industrial growth reinforces persistent demand, insensitive to moderate price increases. Gold forecasts from major banks suggest additional tailwinds for silver valuations. If gold advances while ratios compress, silver exceeds conservative targets. 200 becomes baseline rather than extreme under combined scenarios. Mathematics remains indifferent to media sentiment or temporary volatility. 50 in 1980 equals 200 today when purchasing power adjusts properly. 5,000 divided by 25 equals 200 without interpretation. Institutions accumulate aggressively while headlines promote fear. The discrepancy between narrative and numbers defines opportunity. We do not predict emotionally. We calculate using verifiable data. Silver near 80 represents a structural bargain within precious metals. The repricing event favors patient holders who understand arithmetic. They told you 50 to scare you out. The numbers indicate 200 as the real equilibrium target.